We have Robert Subbaraman of head of global macro research at Nomura. Rob, great to have you back on the program. Good morning, Prashant here. It's just, I think, as my colleague said, Friday the 13th. I think you can tie it off on that because it's all pretty volatile news flow. What do you make of it, Rob? And if you've had a chance to interact with your colleagues who track oil markets, etc. Is there significant upside if this escalates, if the Strait of Hormuz is closed? It's never been done before. What is your sense?
I think it's really hard to tell, Prashant, at this point, whether this is going to be a knee-jerk oil price spike and then things settle down and it's more just between Israel and Iran, or whether this actually broadens out, as you say, Strait of Hormuz, or whether the conflict spreads to other countries in the Middle East, oil producers. The thing for the economies, I guess, and markets is if this oil price continues to rise and it's a sustained rise, then that's when it starts to impact economies, trade deficit, especially Asia, right? India, Thailand, Philippines, Korea, countries like this are large net importers of oil. So you could see exports are already weak because of the US tariffs, and then imports could pick up. So you could see pretty sizable moves in trade balances worsening if oil prices keep rising and stay high. The other thing I'd say, Prashant, we've already got, in the markets, a lot of US policy uncertainty around tariffs, the fiscal concerns, what's going to happen to unemployment, inflation. Markets are only usually good at focusing on one thing at a time, and now they have geopolitical risks rising. So this is a really challenging time for markets. So many different narratives and trying to kind of pass what it means for ultimately growth and inflation and policy responses.
The CPI print for India came yesterday, and I don't know if you had a chance to look at it, but it was at 2.8%. And now there is hope that perhaps it could even undershoot RBI's inflation forecast of 3.7% for the full year. But now this spike in crude prices, 10% up and counting, can throw all the equations into, can question all the equations that they've put in. Now, considering that we had the jumbo rate cut yesterday, would RBI's policy action of last week look a little premature? And how would you, expect that to play out?
So it's a good question. We were actually forecasting 2.8%, so it's in line with our view. And our forecast for this financial year is 3.3%, so below the RBI's target for inflation, or forecast for inflation. So I think the good news for India and to be honest, for much of emerging market economies is inflation is low. In fact, for India, the current account deficit is also quite low. We think it will be less than 1% of GDP this year. And so the starting position is good. Historically, it's been a lot worse than that. So, if oil prices keep rising, India is starting from a relatively strong position, especially historically, to withstand this. So, yes, at the margin, I think for the RBI, it does mean that they would be a bit more cautious on cutting rates here. But we currently expect 2 more rate cuts this year. We still have that as our baseline, but we're watching what happens to oil prices closely. I'd say right now, with what we've seen so far, we're quite comfortable with this view of 2 more rate cuts, just because, inflation 2.8% is well below the RBI's target.
Hi, Rob. Good morning. Good to see you, Win. Rob, we have got softish inflation prints that coming out of the United States in the last 2 sessions. And because of that, if I look at the probability of Fed rate cuts, that's moved up in the last few days. Part of the street believes that in September we get 1, and the next cut could possibly come in October as well. But you're not in that camp. Tell us, what are you expecting in terms of Fed action in this year?
Yeah, so I guess the key word we would use is lags. We think that there are significant lagged effects from when the tariffs started going up, particularly in April, and when we'll start to see it showing up on the prices of items on supermarket shelves and then getting into inflation. I think the key point we would make is if you look at the US import data, there was a massive surge in US imports in March, and that was to beat the tariffs. So US companies, bought a lot of product overseas before the tariffs and kept it as high inventories. Imports came down very sharply in April, but we think, there's still an inventory buffer that's running down, and that's why inflation is still relatively low at the moment. But as we get into June, we think in July, August, those months, we think you'll start to see inflation going up. So, our forecast is core PCE is going to be well north of 3% by the fourth quarter. And that's why we really don't have the Fed cutting until December.
Rob, just one last question. That US-China framework deal, we've not heard anything, or have I missed it? Anything from the Chinese side? Because this is all contingent on, and President Trump said in that post, social media post, that this is contingent on, Chinese president and me sort of ratifying this. We've not heard anything from the Chinese side. So, any thoughts?
I think, Prashant, you're right. From the Beijing side, I think they're keeping their cards pretty close to their chest now. I think from China's side, there was a bunch of non-tariff barriers that the US put up since the truce meeting they had in Switzerland, and I think in Geneva. So I think China's waiting to see, some of those to be removed, and then I think the key thing is then they will gradually relax the export restrictions on rare earth minerals. I think that we would still say that there is significant strategic decoupling happening between the US and China. And I think what we've seen in the last 4 to 6 weeks is China's got a fair bit of leverage on the US, more than what the US kind of thought a few months ago. And so, our view is this is, a bit of a relaxation now. Maybe we may see some positive news, maybe not as positive as President Trump is making out, but tensions in terms of trade and investment and this decoupling between US and China, we think will continue.
Robert, just one final question then. What if tensions in Middle East escalate from here on? And of course, it depends on the extent of escalation, the attacks, the retaliation. But just for the sake of scenario planning, if things get worse from here on, help us with your thoughts.
I mean, it's a very tricky question right now. We're really speculating, but I think in the worst case, the thing I think from an economic market perspective, people are focusing on in particular is going to be the oil price. If things really escalate from here. And I think when we talk about escalate, we mean broadening out beyond Iran and Israel, Strait of Hormuz or other Middle East countries getting involved. And if that really starts to lead to a disruption in oil supply, that can be pretty devastating for the world, which, right now, especially for the net oil importers, which to a large extent is, the countries that are most vulnerable are the emerging markets and frontier economies that would face, already facing weak exports. Growth would come under pressure. So we've got to monitor it carefully. And, I think we're all praying that things settle down from here. But it's just one more significant risk. In a usual year, this would be a big one, but we've just had so many big events and uncertainties right now. And markets so far have been taking a lot of it in their stride. And this will be interesting if this does escalate further, whether it really does lead markets to crack.
Robert, thank you very much for joining in. The hope is that the attacks that we've seen so far are calibrated and the situation de-escalates for now. But you can see the risk of crude prices up 10%, and Asia across the board is selling off. Kospi is down over 1%, Nikkei is down 1 1/3. You've got cuts in Hang Seng, Shanghai, across the board. It's deep in the red.